Someone I've worked with for a long time recently came to me and showed me a whole life insurance policy that was sold to someone else, and the guy stands to lose about $5 million. It's definitely one of the worst situations I've ever seen with a whole life insurance policy. And why it happened was either due to lack of knowledge or greed. It was one of those two reasons. So what I'm going to cover in today's video is the policy that was sold to this individual, how it was sold to them, and then what could have been done differently to give him a ton more value upfront and also long-term. And as I go through everything, what I just want to state is the numbers are going to be quite large. This is an individual who is paying in the high 7 figures per year. However, this stuff happens to everyone. It happens primarily to the middle class. I was surprised that I saw it in this particular situation because usually qualified attorneys protect clients when they see things like this, but this one slipped through somehow. So the situation is as follows. We've got a young guy paying $7.6 million per year into a whole life insurance policy. He's about a year and a half in. His first year cash value was about $2.8 million, which is about a $5 million loss in the first year alone. The break-even point will fall between 7 and 8 years. I'll show you exactly what that means in a little bit. But here's something that I would guess he did not know when he purchased the policy. The agent who sold this policy earned about a $2.6 million upfront commission, which is huge. Now, the problem is coming up because the buyer, the client, is now having second thoughts about a year and a half in, asking some questions such as, can I reduce my premium payments? Can I stop my premium payments altogether? Can I exit? The answer is yes to all three. However, it looks like junk. And I'll go through those numbers and what they look like. Before we look at the actual policy, how this product was sold. You've got a very high net worth individual making tons of money right now. So he's doing well financially. He was recommended this life insurance product from an attorney. I don't know anyone in this situation. My assumption, based on experience and what I see happen, is the attorney knows some of the benefits of cash value life insurance, safe place to put money, I can access the cash value, it's tax-free if I do everything right, the death benefit can be used for estate planning purposes, there's a lot of benefits there. However, often the knowledge stops there for most attorneys, where when they refer it to a reputable agency or agent who says, yes, we work with high net worth clients or we have our own family office intact, here's how we sell policies, a lot of times it stops there and the attorney doesn't know what's going on with respect to the structure of the product and the actual details of that sale. So here's the policy that was sold. The actual premium was a bit higher than $7.6 million per year. I just reran the illustration with round numbers to keep things simple. So here's our yearly premium, $7.6 million. Here's the total cash value, $2.8 million. That's in the first year, meaning it's a $4.8 million loss. The break-even point falls between years 7 and 8. I'll show you that in a moment. That's the first year. The cash value is equal to or greater than his total payments. And by the 10th year, he's paid in $76 million into a life insurance product, and he would have $83 million in change based on the current dividend interest rate with this company. And he's paying into it for 10 years because this is a 10-pay product. What I'll say about the 10-pay product is that it is a product that is designed for cash accumulation. So the long-term rate of return will look the strongest with this particular product. However, the design here is not that good. And here's what I mean when I say design. He's paying $7.6 million per year. That's what he's paying into the product. The question I would ask if I am you buying this policy is, where is my money going? So important to ask that question. There's two main areas where your money can go. It can go toward the base premium or the PUA rider. In the policy he was sold, 100% of his payment is directed toward the base premium. If this was a product other than a 10-pay policy, like a traditional whole life insurance product, the cash value would be zero in the first year. However, a 10-pay product does give you some cash value right out of the gates. It's not zero, but it's still not good. It's about $2.8 million. When I mentioned the break-even point was between 7 and 8 years, here's the 8th year. His total out-of-pocket, $60,800,000. His total cash value, $61,420,000. That is the first year his cash value is greater than his total out-of-pocket, which means what? You run a loss for the first 7 years. For a business owner, could he use that $7.6 million every year to continue to reinvest in his company and continue to grow it? Yes, he could. That is what we call opportunity cost. He's putting it here instead. He didn't know. He didn't know. It's not his fault. He trusted the people that recommended getting this. Happens all the time to so many people with these products. Here's what he could have had. So, what we're going to look at here is the same insurance company, the same insurance product, the same out-of-pocket to him, but we're going to focus on the cash value. And we can look at the death benefit too, because it's not small, is it? No, it's not. 150 mil. All right, the good policy, which is really just the same product, designed differently. Here's what I want to look at. Up top, where is the money going? You pay the same $7.6 million. Your base premium is not $7.6 million. Instead, it's 10% of that, $760,000. The PUA rider is the balance. Now, to add extra detail here for my fellow agents viewing this video, there is a term insurance rider in here that's included in that PUA premium there. So we do have money going toward a term insurance rider, which does raise the death benefit, which doesn't care about that. It prevents a MEC, which is a taxable event. Why people do this, like why they put millions of dollars into cash value life insurance, is because it's a safe place to grow their money. They can access it anytime they want without penalties, and the money keeps compounding when they access it, and it's also tax-free as long as we follow IRS rules. Corporations do the exact same thing. The difference is corporations view the cash value as an asset on the balance sheet, and if they put in $7.6 million, they're looking for about 90% upfront, which here we have that, $6.9 million. We're close to $7 million in cash value in the first year alone. Individuals can do the same thing as corporations. It's just not common knowledge, like it's not shown. What do you notice here? Same out of pocket to him, death benefit's about the same, 140 million instead of 150 million. We can make it 150 million and keep the out-of-pocket the same. The cash value would be 1,870,000 instead. Like there wouldn't be that much of a difference. How would you feel if you were sold this and then found out with the exact same product and company and out-of-pocket to you, you could have had this? $4.1 million more in the cash value in the first year alone. Break-even point between the 3rd and 4th year when he's cash positive. By the 10th year, you've got more than an additional $10 million in cash value. It's like, what is going on? If you scroll down, that gap just widens, doesn't get any better. So, why? Why are people sold policies like this? Which happens if we make this 10K per year, by the way. It's not exclusive to putting away millions of dollars per year into these products. Here's why. If I would have sold this 10-pay product with this company, here's what I would have made. $7.6 million going in, all toward the base premium. 10-pay products pay amongst the lowest commissions when compared to all other products. At our current commission rate, which is near the highest, it'd be 34% in the first year. BP represents base premium percentage. It's the percentage of commission that I'm paid on the base premium in the first year. There are also renewal commissions paid to the 10th year. And purple represents the base premium commission. Then we've got PUAs, 0 because he's not paying anything into PUAs in this example. First year, total annual comp over here in bold, about $2.6 million. This policy is beyond the first year. Like that's done. The renewal commissions, look at that. About $500,000 per year for 4 years. Then it drops to $270,000 and change. The lifetime value of this sale, $5.9 million. That's a huge amount. Like one sale would make many agencies' years with this particular product. Just one sale alone. Now, what if you do it the other way? This will give you some insight as around the conflict of interest in the industry when people are interested in cash value. So here's what could have been done. Exact same product, exact same payment to him. The difference is the premium. We pushed it as low as we could at 10%. Same commission rates. Like when you look at the base premium and PUA percentage, it's exactly the same. What's the difference? That 34% base premium rate is paid on that premium that we pushed down because that does not generate cash value immediately. Only a small percentage of it goes toward cash value. And we pushed everything else into the paid up additions rider, which does generate cash value. Now, companies do pay commissions on PUA payments, but the PUA payment, why the consumer wants it, is because of that immediate cash value. Again, that's why they're interested in it. Base premium dollars, they do generate cash value, but it's not, we don't really see the value until a ways down the road. But with this, if I look at the total annual compensation, the first year is what? About $400,000. And when you tally up the renewals and go to the 10th year, what's your lifetime value? $1.96 million. Same company, same product, same out-of-pocket to him. Over 10 years with this setup, you make less than what you would in 1 year with the other setup. When you look at policies that are sold with aggressive premium designs, it's more than 90% of sales in the life insurance industry are sold in that manner, which tells us exactly what's going on. Now, what I want to mention here, his questions around the second thoughts. Can I reduce my payments? Can I stop payments? Can I exit this? What happens if you exit a whole life insurance policy? Do you know? You'd walk away with the cash value. And it's whatever your cash value is with a whole life. With universal life, it would be what is called your surrender value. So it's always important to be aware of that distinction. But if we go to his policy, if in the first year he exited, he'd get $2.8 million. In the second year, which he's in the second year, he's paid half of the second year's premium, 15.2 paid in, he'd walk away with $7.8 million, which is more than a $5 million loss. That hurts. So, what can he do? Here's his current policy. If he wants to stop, he can stop. That is possible. How he would stop is the dividends and interest would partially support the premium, and then loans would also be taken to support the rest of the premium. There's not much we can do in terms of reducing the premium because with this particular product and the way it was set up, it would trigger a MEC, a taxable event. He could pay a partial premium. That's possible if he said, hey, can I use the dividends to support it and then I'll pay some of it out of pocket? Yeah, you could do that. But if he wants to pay nothing, here's where that's hard. Second year, 7.8. If he pays nothing, his cash value balance goes down. After the 7th year, we would reduce the death benefit. That's the earliest we could do it to reduce costs. And you'll notice at that point then, cash value starts to increase. When does he get his $15.2 million back? He started this policy in his late 20s. He wouldn't get it back until right around the age of 50. Is that worth it? Probably not, because if that's me, I would say, man, like I could use that 7.8 today to generate a whole lot more than 2x its value over the next 20 years, being that he's done that with his company. versus what could have been done. It's where it's so important just to ask questions or have multiple people vet this. Here's his annual funding for 2 years and then 0 thereafter. The premium over here, look at this, still due. He's not paying it. The dividends and interest in the policy are supporting it. Why this one works though, and this one doesn't, is because with this one, it has to support this humongous premium. Like there's not even that much in cash value. That's the problem. Whereas over here, look at this, by the second year, he's got 14.4. That can easily support the premium, the dividends and interest that are being produced, loans are not taken, and I see it continue to grow, where he breaks even still between years 3 and 4 without paying it. And then it keeps on compounding. We do the same thing where we reduce the death benefit, and the cash value keeps on compounding over time, just by designing the policy correctly. So when it's designed with high cash value up front, that means I have a low premium, which I can stop paying in most cases because it can be supported internally. If I want to keep paying it, I can. I could pay this, I could pay $1 million, $2 million, anywhere all the way up to 7.6 million. So I've got flexibility. It's not an all or nothing decision, which is nice. And I get my money back quickly, which is huge. So what's the lesson here? Well, 2 things that I see happen all the time. Firstly, how do I avoid buyer's remorse? Ask to see different options. And if you're not comfortable with it, or if you don't understand it up front, I just wouldn't move forward until you are comfortable or you do move forward. If you have advisors you're working with, ask if they trust the person that they're referring and if they understand the product. Don't worry about offending the agent or anyone you're working with. A lot of times this happens. I know it's like, what? Like, why would somebody be worried about offending an agent? So many times this happens because people get emotional. There's a client that I've worked with for almost 5 years now. He started a policy. He put $1 million into his policy year 1 and year 2. He met with a different agent who sold cash value life insurance. This guy has been in the business for a very long time, very, very successful. The client that I've worked with for a long time will ask you every question you can imagine and really lean into the details. He wants to understand the why behind it. This other agent got annoyed with him and asked him, why are you asking me these questions? Other people don't ask this. And the client's like, all right, forget it. Like, I'll just stop, because he was uncomfortable. He felt like he was being annoying to that agent. But the thing that happens all the time is most people don't press. They stop asking questions and say, okay, you've shared enough with me. I'm comfortable moving forward. They move forward, and then something like what you just saw happens where they lose a lot of money. Doesn't work. If only I would have asked questions to start. It is okay to ask questions. Don't worry about offending anyone. If you ask me a ton of questions and I come off as annoyed or offended, fire me. Like, it's your money that we're dealing with here. So that's what I would recommend. And ask to see different options. If your agent won't show them, ask other agents to show different options. Protects so many people from so many bad deals. And then what I would look for, a way to simplify things, first year, if my cash value is between 80 and 90%, I'm usually good. And if my break-even point is between 3 to 5 years, I'm usually good. That is an indicator that the policy was set up for minimum commissions, maximum cash value. When you see those 2 things combined with each other in most situations. There's some products that are a little bit tricky, but if you see that, you're usually good. And the last thing, remember, this applies to anyone, whether it's $7.6 million per year, whether it's $76 million per year, or whether it's $7,600 per year. It's all relative as long as that product is designed the same with that low premium and aggressive PUA piece. That's how you enrich the cash value of a life insurance policy and protect yourself from a life happens scenario. So I hope this video was helpful. I'd love to hear your thoughts. If you have any questions, comments, or want to connect, please let us know in the comments below, or you could reach out to us on our website or LinkedIn. That is my platform of choice. And as always, I hope this helps.